In this chapter, we're going to think about the way that we deal with income taxes. So there's going to be two main topics in this chapter. We're going to talk about inter-period and intra-period tax allocation. So let's think about inter-period tax allocation first. So this means between time periods. So the reason that we're having this discussion is because it is possible and very likely that there will be differences between our financial statement income that we recognize on our income statement and the taxable income that we're going to recognize on our income tax forms. Now, not always. It might be that this income is the same, but it's pretty likely that there are going to be differences between these two amounts because we treat items of income and expenses differently for tax purposes than we do for financial statement purposes. Sometimes these differences are always going to be different. That would mean that they are permanent. They will never reverse because perhaps maybe there's items of income that we have that is not taxable, like municipal bond income. We are never going to recognize that for tax purposes, but we are for financial statement purposes. So when we have these permanent differences, they will never reverse, and we're not going to do anything with that because we're never going to see that reconciliation happen. However, there are also temporary differences that will arise between financial statement income and taxable income that are only because of timing differences. Because for tax purposes, we tend to recognize revenue and expenses when the cash happens. So when we receive cash or when we pay cash is when we recognize the revenue or expense. We know for financial statement purposes that is not the case. We're going to recognize revenue when it's earned and realized, and we're going to match the expenses to that time period regardless of when cash is actually received or paid. So because of that, we're going to see some temporary differences that will eventually reconcile. So permanent differences will never reverse. There are always going to be differences. But temporary differences will eventually reverse, and we'll recognize that income or expense just in a different time period than we would for financial statement or tax purposes, depending upon which way we're looking at it. So when we have these differences, they arise because of either future taxable amounts, which we're going to call FTA, or future deductible amounts. So this just refers to the way that we would treat these for tax purposes. So these amounts, these are the full amount of the difference. And if we have a difference in income for financial statement purposes and tax purposes, that's going to end up resulting in a difference in the income tax expense, because the income tax expense is going to be tied to our financial statement income, and the income taxes that we actually have to pay, which is going to be derived from our taxable income. So when we have these differences in income, which these temporary differences are going to give rise to one of these, that is going to give rise to a difference in the expense or the payable that we have to recognize. So when we have a future taxable amount, if we multiply this times whatever applicable tax rate is for the particular period, future taxable amounts are going to lead to deferred tax liabilities, while future deductible amounts are going to lead to deferred tax assets. So we see these arise. We see a future taxable amount arise when our financial statement income is greater than our taxable income at a point in time. Now, this can happen, this is at the origination of the difference, not going forward, but at the origination where we first see an event cause a difference. And these events can arise because we are recognizing less future expense for tax purposes, or we're recognizing more future revenue for tax purposes. That's what would give rise to a future taxable amount and cause our financial statement income to be greater than our taxable income at origination, which would then lead to a deferred tax liability. Now, for a future deductible amount, it's just going to be the opposite. So in that case, we're thinking about our financial statement income being less than our taxable income at origination. And that's because we are going to recognize more future expense for tax purposes, or recognize less future revenue for tax purposes. That's what would lead to a future deductible amount. Now, when we recognize a future taxable amount, which leads to a deferred tax liability, or a future deductible amount, which leads to a deferred tax asset, we need to make sure that our users of our financial statements know about that. So we're going to recognize a deferred tax liability or a deferred tax asset in our financial statements. So let's think about deferred tax liability first. So when we recognize this deferred tax liability at origination, we're going to make that have what we want is we want it to have a credit balance, right? So when we do that, we would recognize income tax expense and recognize a deferred tax liability for the difference between the expense that we're recognizing and the liability that we're recognizing. Because what's happening is, for some reason, there are lots of possibilities, and you can look at those in the chapter that would give rise to this. But for some reason, we have a difference between our financial statement income and our tax income. So at the origination, our financial statement income is greater than our taxable income. So that means our expense is going to be greater than our payable. So the difference there is going to be this deferred tax liability, saying in the future, we're going to have a taxable liability arise because of this difference. Now, this is going to eventually reverse, right? We're going to recognize it for tax purposes. So that means eventually, slowly, we're going to reduce our deferred tax liability. So as that happens, we would need to pull out however much of that liability is being eaten up as this reverses. So you can see as this would reverse, we would have a difference in our income tax expense and our income tax payable. So as this happens, we're slowly recognizing it for tax purposes. So that means that the taxes we pay is going to be greater than the expense that we recognize. And so we're going to be reducing our liability as we go until eventually the liability makes it to zero. Now, this would be if we only had one temporary difference. Likely, companies are going to have multiple temporary differences. So we would need to constantly be thinking about our beginning balance of our deferred tax liability and where we need our ending balance to be. So it might be that we're not always, debiting the liability to get rid of it, because we might have a new temporary difference that would cause us to credit it. So you just have to know what you want your ending balance to be at the end of the year and adjust accordingly. So likewise, our deferred tax asset would work just exactly the same as what we've been talking about with the liability, just with a debit balance, right? So when we first recognize this, we would have an amount here. This would mean that the difference between our income tax expense and our income tax payable, because these amounts are generated based on our net income here and our taxable income here. So if we have a deferred tax asset, that means we have a future deductible amount. So our financial statement income is less than our taxable income. So our income tax expense is going to be less than our payable. So we balance that with a deferred tax asset. And as we go, we would need to reduce it until eventually it gets to zero, or we would need to adjust it until we get to the ending balance that we need for the year. So anytime we adjust it, we're going to be thinking about the relationship between our income tax expense and our income tax payable. And if we want to reduce that asset, it would just look like that. In general, companies are not as excited when they have a deferred tax asset as a deferred tax liability. So deferred tax assets are not as desirable. Because in general, we want to try to minimize our tax liability today. So this is kind of a little different way to think about liabilities and assets, because companies aren't usually very excited when they have to recognize a deferred tax asset. Whereas a deferred tax liability, even though it's going to be an increase to your liabilities in your balance sheet, it means you're paying less taxes today. When we think about our main cornerstones of accounting, we know that one thing we always have to consider is that we need to be conservative. So this applies to assets and revenues the most. So when we recognize a deferred tax asset, one thing we need to ensure is that we're not overstating this asset. Therefore, when we recognize a deferred tax asset, we are going to use a valuation allowance in order to reduce it in the event that the net realizable value of that deferred tax asset decreases. So this net realizable value needs to be the amount that is more likely than not that we are going to recognize. So if the deferred tax asset amount that we have on our balance sheet is greater than what the net realizable value is, we need to reduce it by this valuation allowance. So this should be a familiar concept, like from accounts receivable and things like that. We've used an allowance like this before. When we recognize this allowance, we will increase our income tax expense when we increase our valuation allowance. That's how we're going to bring this into being. Now, another piece of inter-period income tax allocation is when a company has a net operating loss. Now, for tax purposes, they can carry this net operating loss forward for 20 years, or we can carry it backward for 2 years. That's for tax purposes. Even if we do this for tax purposes, we still are going to recognize the benefit in the financial statements when the loss occurs, because we recognize things in our financial statements when they actually happen. So when we bring this net operating loss back, when we carry it back in order to recognize a refund of taxes that we paid in the past, we would recognize that we have a receivable. We're going to receive that. We would increase a deferred tax asset, and we would recognize an income tax benefit related to an operating loss. When we carry this forward, we'll recognize a deferred tax asset and recognize the income tax benefit, because we won't be getting a refund if we carry it forward. We know that that's going to apply to the future. We're going to have a deferred tax asset because we're going to have a future deductible amount. We're going to reduce our taxable income in the future by this loss. So those are how we deal with inter-period tax allocation. Real quick, I just want to think about how we think about intra-period tax allocation. So this just means within the period. All this means is that we need to be sure to show the users of our financial statements how our taxes are being allocated throughout our financial statements. So this just means that we need to break up the income tax expense that we're recognizing for continuing operations to show how it applies to our continuing operations, as well as how it applies to our discontinued operations. So we need to show in our continuing operations, we would do that by recognizing income tax expense. In our discontinued operations section, we're going to show everything there net of tax so that our users can get an idea of how the tax allocation affects each of those types of operations differently. So this is how we think about our income tax allocation when we have differences between our financial statement and taxable income, and how we include these amounts in our financial statements throughout the year.